Hello everyone, my name is Nica Zabate and we'll be discussing more about share-based payment. So what is a share-based payment? Share-based payment are additional compensation given to the employees. Through this, employees shall receive shares of capital in exchange for their services or incur liabilities. There are two kinds of share-based payment: the equity settled and the cash settled. Equity settled issues equity instrument like share option, and cash settled ensures a liability like share appreciation right. But I'll be focusing more on the equity settled. Equity settled that issues share option. So what is a share option? Share option are optional and it is a contract that gives the holder the right but not the obligation. There are two methods of share option, the fair value method and the intrinsic value method. I'll be focusing more on the fair value method, and intrinsic value method will be discussed by my group mate. So there are two kinds of recognition in the compensation. The share option vest immediately and the share option that do not vest immediately. To furthermore that we can understand this, I will be sharing you illustration to understand what is the meaning of vest immediately and do not vest immediately. Illustration 1. On January 1, 2024, share options are granted to employees to purchase 80,000 ordinary share of par value at 60 per share. On this date, the fair value of each share option is 15. The options are vested immediately. Take note ha, vested immediately. Meaning the employees can exercise options immediately. Employees exercise all their share options on December 31, 2024. Provide journal entries. So kay vested man siya immediately na exercise ra man ang ilang option, journal entries ra atong himuon. So on January 1, 2024, debit salaries expense, giunsa man ni pagkuha 80,000 gikan sa ordinary shares times 15 sa fair value sa share option. That's what we come up with 1,200,000. Ja credit card share option outstanding 1,200,000. On December 31, 2024, na-exercise naman nila ang ilang mga share options, mag-debit ta og cash 80,000 times 60 per share, na atay 4,800,000. Diya mag-debit po ta og share option outstanding 1,2. Diya mag-credit ta og share capital 80,000 times 50 ang par value ni. So we come up with a 4 million. Diya ang ijang nahibilin mao na atong i-credit as share premium, which is 2 million. Illustration 2. On January 1, 2020, an entity granted 300 share option each to 400 employees, conditional upon the employees remaining in the entity's employ during the vesting period. Take note na natay vesting period. The share options vest at the end of 3-year period. On grant date, each share option has fair value of 30. By December 31, 2020, 20 employees have left, and it is expected that on the basis of weighted average probability, a further 25 employees will leave during the vesting period. By December 31, 2021, 27 employees have left, and the entity expects that a further 30 employees will leave during 2022. By December 31, 2022, 25 employees have left. Compute for the compensation each expense each year. So mo ang formula nga atong gamiton para makuha nato ang salaries expense during the 3-year investing period. So year 1, 2020. Number of employees, natay 400 ka number of employees. Pag December 31, 2020, 20 employees have left. Less na nimong 20 employees. Plus furthermore, 25 employees pa kuno ang muhawa, matong ilas po na nato. So naa na naman tayo 355 ka employee entitled for benefit. I-multiply na siya sa share option. Pila ka share option? Natay 300 share options. So, i-multiply na nimo siya, makam up ka og 106,500. I-multiply na po na nimo siya sa atong fair value, which is 30. So, multiply na siya. The total compensation is 3,195,000. I-multiply na po na siya sa vesting period. Ang kaning vesting period, 3 atong gigamit diri kay nabjay given nga. 3-year period. So, i-multiply na nato si Jag 1, divide 3, na atay 1,065,000. So, atong salaries, dito mo less cumulative compensation for previous year, kay mami natong kinaunhan nga year. So, sa 2020, na atay salaries expense during the year is 1,065,000. Year 2, 2021. natay 400 ka employees. Ningingon diri by December 31, 2021, 27 kuno ka employees ang left. So ato na siyang i-less dira og 47 kay naaman tay 20 sa previous year. Diyan na ako ni muli mo hawa nga mga employees 30 ka buok mao na ang ato na lamang employee nga entitled for benefit is 323. It multiply na po na siya 300 sa share options. So natay 96,900. I-multiply sa fair value which is 30, natay 2,907,000. Na i-multiply na po siya sa vesting period which is ikaduha naman nga year mo na sang 2,907 i-times na siya sa 2 i-divide og 3 na naman tayo 1,938,000. I-less siya sa cumulative compensation the previous year which is the 1,065,000. Less na naman tayo salaries expense sa year 2 2021 873,000. So sa year 3 pod, same ra gyapon nga process. Natay ning left ay natay 400, ning left 47. Janingon man dire wala na may ning hawa nga mga employees pag December 2022 pero ay na ning hawa nga 25 mo ning i-less ni panid natong 25 na naman tayo entitled nga employee 328. I-times na po na siya sa share option atay 98,400. Multiply by the fair value of 30 na atay 2,952,000 divide 3 i-divide og 3 i-times og 3 i-divide og 3 mao ra gihapon na so mao ra gihapon ang value i-minus siya sa mga cumulative compensation sa previous year which is 1,065,000 pag 2022 and 873,000 pag 2021. So ang atong year 3 nga 2020 ang atong year 3 2022 salaries expense is 1,014,000. So mo ni yung journal entries. December 31, 2022, debited salaries expense which is 1,065,000. Credit share options outstanding 1,065,000. December 31, 2021, salaries expense of 873,000. Credit share option and outstanding 873,000. December 31, 2022, debit salaries expense, credit share option outstanding which is 1,014,000. Last illustration. On January 1, 2021, an entity granted to an executive 20 share options to purchase 20,000 50 par value shares at 100 per share, conditional upon the executives remaining in the entity's employment until December 31, 2021. If the earnings increase by at least 10 per year over the 3-year period, the exercise price will drop at 80 per share. On the grant date, fair value of the share option is 30 if the exercise price is 80, 25 if the exercise is 100. So during 2022 and 2023, the earnings increased by 12% and 11% respectively, but during 2021, earnings increased only by 4%. So ang giingon dire, kung mo-increase ko no ang ilang earnings by 10%, mo-drop ang ilang price to 80 per share. So kung ang exercise price kay 80 kuno, naa sila 30 per share options ang ilang fair value. Kung ang exercise price kuno kay 100, 25 na naman ang ilang fair value sa ilang share option. So compute the compensation expense each year. So kung wa man nag-mention of employees, number of employees, diretso ta sa compute sa share option. So share option 20,000 kuno. I-multiply sa fair value kay 2021 man ni di ba ingon nga kung mo increase at least 10%, ang ilang exercise price is 80 per share. So 30 atong fair value nga gamiton kay ingon diri nga during 2022 ang 2023 ang earnings kuno kay ning increase og 11%. So pasok sa 10%. So 30 fair value atong gamiton. Naatay total compensation of 600,000 times sa vesting period, naatay cumulative salaries expense 200,000 less watay less, so naatay salaries expense during 2021 200,000. 2022 20,000 share option, fair value nato 30 gihapon tong gamiton kay nakalapas man siya sa 10%. So 600,000 gihapon i-multiply sa vesting period natay 400,000 sa 2022. I-less just sa cumulative compensation sa 2021 which is 200,000. So sa year 2022 salaries expense is 200,000 gihapon. 2023 20,000 gihapon ang share option. So kay ang 2023 gimension man dire nga during 2021 kuno ning increase ra siya og 4%. So wa si siya nakapasok sa atong 10% nga average. So atong gamiton ingani is ang iyang 25 nga fair value kay exercise price is 100. Wa man siya kasud sa 10%. So 25 na tay 500,000 multiply sa vesting period nagyap tay 500,000 less sa cumulative compensation sa previous years which is 200,000 sa 2021, 200,000 sa 2022. Naa na naman tayo salaries expense sa 2023 which is 100,000.
Let's tackle intrinsic value method. Intrinsic value method according to PFRS 2. If the fair value of the share options cannot be measured reliably, the entity shall measure the share options at their intrinsic value initially and subsequently at its reporting and at the date of final settlement, with any change in intrinsic value recognized in profit or loss. So any change in intrinsic value is recognized in profit or loss, meaning an increase leads to higher expenses while a decrease results in a gain. This ensures that compensation expenses reflects the changing value of share-based payments over time. The intrinsic value of a share option at any point in time is the difference between the market price of the underlying shares and the exercise price of the option. The date of grant commonly the exercise price is at the market value of the shares at grant date. So, at the grant date, the exercise price is typically set equal to the market value of the shares, meaning the intrinsic value is initially zero. However, as the market price fluctuates over time, the intrinsic value may increase or decrease, impacting the financial reporting of share-based payments. Often, employee share options have zero intrinsic value. Therefore, in many cases, valuing share options at their intrinsic value at grant date is equivalent to attributing no value to the options. So, as a result, valuing the share options using the intrinsic value method at the grant date often means assigning no initial value to the options. This approach can underestimate the true economic cost of share-based payments, as it does not count for the potential future increase in share price, which gives the options value over time. Here is an example of the intrinsic value. So the problem is, on January 1, 2021, Awakco grants 100 share options to 50 employees. The share options will vest at the end of 2023, provided the employees remain in service until then. The share options have a life of 5 years. The exercise price is 50 pesos and the entity's share price is also 50 pesos at the date of grant. At the date of grant, the entity concludes that it cannot estimate reliable fair value of the share options granted. At the end of 2021, 3 employees have ceased employment and the entity estimates that a further 5 employees will leave during 2022 and 2023. Hence, the entity estimates that 80% of the share options will vest. 2 employees leave during 2022 and the entity revises its estimate of the number of share options that it expects will vest to 86% of or 4,300 share options. 2 employees leave during 2023, hence 4,300 share options vested at the end of 2023. The entity's share price during years 2021 to 2025 and the number of share options exercised during years 2024-2025 are set out below. Share options that were exercised during a particular year were all exercised at the end of that year. Let's start the first illustration. So first is the share price and stock option exercise. The table at the top shows how the share price changes yearly and the number of stock options exercised by employees. From 2021 to 2023, no stock options were exercised. In 2024, 2,600 options were exercised, and in 2025, 1,700 options were exercised. The share price increases from $61 in 2021 to $100 in 2025, indicating an upward trend. Then the salary expense calculation 2021 to 2023. This section calculates how stock-based compensation affects salaries. First is we determine the total stock options. Employees entitled to the benefits are recorded as 42 in 2021, 43 in 2022, and 23. Each employee receives 100 stock options. So the total stock options are 4,200 in 2023, 4,300 in 2022, and 4,300 in 2023. They are just being multiplied by the 100 stack options. Means 42 times 100 equals 4,200. 43 times 100 equals to 4,300. 43 times 100 equals to 4,300 in 2023. Calculating the total value of compensation. The intrinsic value, the increase in share price, is multiplied by the total stock options. There is $11 in 2021, meaning it is multiplied by the total stock options. In 2021, 4,200 times 11 equals 46,200, and $15 in 2022, 4,300 times 15 equals 64,500. $20 in 2023, 43,000 times 20 equals 86,000 in 2023. Allocating compensation over 3 years. Since stock options are typically vested over multiple years, the total value is allocated proportionally. In 2021, one-third of 46,200 is 15,400. In 2022, the two-thirds of 64,500 is 43,000. In 2023, the three-thirds of 86,000 is equals to 86,000. The salaries expense is being calculated by subtracting cumulative salaries of previous years. In 2021, expense is equals to 15,400. In 2022, expense is 27,600. When getting the total expense of 2022, we must minus the 2023 in 2021, meaning 43,000 minus 15,400 will be the value of expense in 2022. 2023 expense equals to 43,000. Number of employees entitled for stock options 2021 to 2025. This section determines the number of employees who qualify for stock options. The company starts with 50 employees each year. Some employees leave the company, 3 in 2021, 5 in 2022, and 7 from 2023 onward. Some employees are expected to leave in future years. The final number of employees entitled to stock options is 42 in 2021, 43 in 2022, and remains 43 until 2025. So let's proceed to the second picture. First is the intrinsic value computation 2021 to 2025. The intrinsic value of stock options is calculated as intrinsic value equals fair value of options less exercise price. So from year 2021, the fair value of options is 61, the exercise price is 50, and equals to intrinsic value of 11. In 2022, the fair value of option is 65, and the exercise price and equals to 15 intrinsic value. In 2023, 70, exercise price is 50, equals to intrinsic value of 20. And in 2024, there is 88 fair value of options and exercise price of 50 equals to 38 of intrinsic value. And in 2025, there is 100 fair value of options and 50 exercise price equals to 50 intrinsic value. The fair value of options increase yearly, reflecting the rising share price. The exercise price remains constant at $50, meaning any increase in share price raises the intrinsic value. The intrinsic value grows from $11 in 2021 to $50 in 2025. So salary expense computation for 2024 and 2025 is that they are computed based on the change in intrinsic value. First is we compute the change in intrinsic value. Change in intrinsic value equals current year intrinsic value less previous year intrinsic value. So in the year 2024, there is 38 current year intrinsic value and 20 previous year intrinsic value will equals to 18 change in intrinsic value. And in 2025, there is 50 current year intrinsic value minus the previous intrinsic value, which is 38, equals to 12 change in intrinsic value. Now we compute the salary expense. Expense for exercise options. Salaries expense equals in intrinsic value multiplied by the number of share options exercised. In 2024, there is 18 change intrinsic value less number of share options exercised 2,600 equals to 46,800. And in year 2025, and the value of change in intrinsic value is 12 less number of share options exercised, which is 1,700 equals to 20,400. Expense for unexercised options. For 2024, unexercised stock options also contribute to salary expense. Change in intrinsic value multiplied by the number of share options not yet exercised. So the year of 2024, there is 18 change in intrinsic value less 1,700 of the number of unexercised options and the total of 30,600. Thus, total salary expense for 2024 is 46,800 plus 36,600 equals to 77,400. For 2025, no additional unexercised options contribute to salary expenses. Let's proceed to the journal entries for stock option expenses. The accounting entries recognize salary expense and stock options outstanding each year. So we must copy the memo entry since there is no value. We still journal it. On January 1, 2021, account memo entry, there is no value. So in December 31, 2021, salaries expense is debited, which is 15,400, and the share options outstanding 15,400 credited. December 31, 2022, salaries expense debit 27,600 and share options outstanding 27,600 credit. And December 31, 2023, salaries expense 43,000 debit, share options outstanding, which is credit 43,000. And December 31, 2024, salaries expense 77,400 debited, share options outstanding 77,400 credited. And in December 31, 2025, salaries expense is debited 20,400 and the share options outstanding 20,400 credited. For the adjustment of share price change in 2025, the table assumes that in 2025, the share price reaches $100. However, if the actual price If the actual share price is $80 instead of $100, there is a decrease in intrinsic value, requiring an adjustment. The intrinsic value at $80 would be 30 instead of 15. So an adjustment of $13,600 is recorded. Journal entry for December 31, 2025. The account is share options outstanding 13,600 debit, gain due to increased intrinsic value 13,600 credit. This reduced the recorded stock-based compensation to reflect the lower intrinsic value. So the third illustration or the third fact, the image presents a computation of salary expense for 2025 based on change in intrinsic value of stock options. First is the change in intrinsic value for 2025. The intrinsic value is calculated as fair value of share less exercise price. For 2025, 80 minus 50 equals to 30. For 2024, 88 minus 50 equals 38. Change in intrinsic value is 30 minus 38 equals 8. Since the intrinsic value decreased by 8, this results in a negative adjustment. Effect on exercise share options. Number of share options exercised in 2025 is 1,700. Change in intrinsic value is 8. Total impact of 1,700 multiplied by 8 equals 13,600. This creates a reduction in salary expense gain of 13,600. So the effect on unexercised share options, change in intrinsic value of 12. So the number of unexercised options is equals to 0. The total impact would be also 0. Since there are no unexercised options, no additional salary expense is recorded. For the final salary expense for 2025, the total salary expense is 13,600. The negative value means the company recognized a gain of 13,600, reducing expenses. And now let's proceed to the classification of share-based payment transactions with a net settlement feature for withholding tax obligations. To comply with this, some share-based payment plans include a net settlement feature, where the company reduces the number of shares issued to the employee by the amount needed to cover their tax obligation. Instead of issuing the full number of shares and requiring the employee to pay taxes separately, the company withholds a portion of the shares and converts them into cash for tax payment. This ensures compliance with tax regulations while still delivering the remaining equity instruments to the employee. And in addition, where necessary, an entity shall disclose an estimate of the amount that it expects to transfer to the tax authority to settle the employee's tax obligation. Let's proceed to the illustration. The tax law in Philippines jurisdiction requires entities to withhold an amount for an employee's tax obligation associated with a share-based payment and transfer that amount in cash to the tax authority on the employee's behalf. This means that when an employee exercises share options or receives shares as part of a compensation plan, the company is responsible for calculating and deducting the applicable tax. To fulfill this obligation, companies often use a net settlement approach, where a portion of shares is withheld and converted into cash to cover the tax payment, ensuring compliance with tax regulations. Here is the problem. So, on January 1, 2021, governing body company which operates in a Philippine jurisdiction grants an award of 100 shares to 10 employees. That award is conditional upon the completion of 4 years service. The entity expects that the employee will complete the service period. For simplicity, this example assumes that none of the employees' compensation qualifies for capitalization as part of the cost of an asset. The terms and conditions of the share-based payment arrangement require you to send the entity to withhold shares from the settlement of the award to its employee in order to settle the employee's tax obligation. That is the share-based payment arrangement. has a net settlement feature. Accordingly, the entity settles the transaction on a net basis by withholding the number of shares with a fair value equal to the monetary value of employees' tax obligations and issuing the remaining shares to the employee on the completion of the vesting period. The employee's tax obligation associated with the award is calculated based on the fair value of the shares on the vesting date. The employee's applicable tax rate is 30%. At grant date, the fair value of each share is 5 pesos. The value of each share is at 31 December 24 is 15 pesos. Here's the breakdown of the computations. First is the share options allocation. Each eligible employee receives 10 share options. 100 employees are entitled to the benefit. Total share options per year equals to 1,000. It is 10,000 multiplied by 100 employees equals to 1,000. And second is the fair value calculation. Fair value calculation per option equals to 5 pesos. Total fair value of options equals to 1,000 multiplied by 5 equals to 5,000. Third is the expense recognition over 4 years. The total fair value is allocated for over 4 years using a vesting ratio. In 2021, 1/4 is multiplied by 5,000 equals to 1,250. In 2022, 2/4 is multiplied by 5,000 equals to 2,500. And in 2023, 3/4 is multiplied by 5,000 equals 3,750. And in 2024, 4/4 multiplied by 5,000 equals to 5,000. The salaries expense each year is calculated as the difference from the previous year. In 2021, there is 1,250. And in 2022, 1,250 because 2,550 less 1,250 is equal to 1,250 in 2022. And in 2023, there is 1,250, meaning that 3,750 less 2,500 minus equals to 1,250. And in 2024, 5,000 minus 350 equals to 1,250. And in journal entries, recognition of salaries expense 2021, 2022, 2023. Each year, the salaries expense is recorded along with a corresponding liability under share options outstanding. And December 31, 2021, salaries expense debit, share options outstanding 1,250 credit. Similar entries are made for 2022 and 2023. Final year recognition 2024. The last portion of the compensation is recorded December 31, 2024. Salaries payables are 1,250 debit and share options outstanding 1,250 credit. Net settlement and withholding tax 2024. Instead of issuing all share options, the company withholds them to cover employees' tax obligations. The tax amount is recorded as a withholding tax payable. Share options outstanding 4,500, withholding tax payable 4,500. Tax settlement 2025. The company remits the withheld amount to the tax authorities. December 31, 2025, withholding tax payable 4,500 and cash 4,500. On the second illustration, determining total share options. Each employee receives 10 share options. 100 employees are eligible. Total share options granted equals to 10 times 100 equals to 1,000. Second is calculating the fair value of options. The fair value per option equals to 15 pesos. Total fair value equals to 1,000 times 15 equals to 15,000. Tax liability calculation. The applicable tax rate is 30%. Withholding tax payable equals to 15,000 times 30% equals to 4,500. Then let's proceed to the share and cash alternative accounting treatment. First is continue to recognize the original fair value of the instrument in the normal way. Even if the modification reduces the fair value of the share-based payment, the original fair value at the grant date is still recognized as an equity settled transaction. This ensures that the original compensation cost remains in the financial statements. Second, recognize the liability to settle in cash at the modification date. When a cash alternative is introduced, a liability must be recorded. The liability is based on the fair value of the shares at the modification date and the extent of services already received. Third is remeasure the fair value of the liability at each reporting date and at settlement. Unlike equity settled transactions, the cash alternative liability must be remeasured at fair value every reporting period until settlement. Any changes in fair value are recorded in profit or loss, reflecting fluctuations in market value. Fourth is the balance of the equity component value of the equity instrument. The equity portion is adjusted based on the formula. The original fair value at grant less fair value of cash alternative at modification, multiplied by the number of share options and multiplied by extent of services received. This adjustment ensures that only the excess fair value, the what remains as equity after accounting for the cash alternative, continues to be classified as equity.
So we are now done tackling the chapter 33 or the share-based payments. Now we will going to discuss the second chapter, which is the chapter 34 or the book value and earnings per share. So on my part, I will be discussing the first part or the book value per share. So unsa man dining si book value per share? So book value per share, it is the amount that would be paid on each share assuming the entity is liquidated. So for example, so nipalit ka og 1,000 shares sa company amounting to 100 pesos par value each. So at the end of the year, the entity has decided to cease its operations and decided to liquidate its assets. So, ang book value per share, it is the expected amount that the shareholders will receive assuming that the entity's assets will be realized at its book value. And usually, ang si book value kay mas taas or mas higher compared sa par value recorded pag purchase nimo sa imong shares. So for this discussion, we will be learning how to compute for the book value per share. But before that, we will be first familiarize ourselves with these concepts or terms that will be necessary in computation of the book value per share. So we have the preference shares and the ordinary shares. So it could be that a company would issue preference shares and as well as the ordinary shares. So if it is a preference share, the shares may be preferred as to assets or as to dividends. So if it is preferred as to assets, the preference shares is entitled not only to the liquidating dividend value but also to the dividend in arrears. So unsa man ning si dividend in arrears? So when we say dividend in arrears, those are the dividends that are not declared by the company for the previous years, but even if wa nag-declare ang company, the preference shareholder is still that entitled to the undeclared dividends. So, og ang preference share kay gi-preferred as to dividends naman, on the other hand, the preference share has the right to receive the dividend first before any dividend is given to the ordinary shareholders. So meaning, inigpanghatag sa dividends, mas mauna hatagan or mas i-prioritize ang mga preference share holders. So the dividend right may be non-cumulative, we have also cumulative, non-participating, and participating. So later, we will be defining these terms as these are important considerations in computing for the book value per share. So next is the ordinary shares. So unsa po dining say ordinary shares? So these are the residual amounts after deducting the preference shareholders' equity from the total shareholders' equity. So, mao ni akong giyon ganina nga nay mga dividend rights. So, we have first the non-cumulative preference share. So, unsa man ni siya? So, when we say non-cumulative, dili siya magpuno-puno. So, meaning the preference share is entitled only to the current year dividends and wa nay labot tong mga undeclared dividends from the previous years. But if the preference share is cumulative, on the other hand, the share is entitled to all dividends in arrears, so it is entitled to all undeclared dividends from the previous years. So murag binalis dyan no. So bisan pag wa gi-declare sa company ang dividends pag 2021, for example, and then year 2022, kung nag-declare, the preference share is still entitled to the undeclared dividends from 2021. So, we have also the non-participating preference shares. The preference share is entitled to receive only dividends equal to the fixed rate. So, if mo purchase ganit tag preference shares, there is a corresponding fixed rate na mauna siya ang rate nga madawat nimo nga dividend. So, if non-participating ang imong preference share, you are only entitled to the dividends equal to the fixed rate. However, if your preference share is participating, on the other hand, the preference share is entitled to receive dividends in excess of the basic or the fixed rate. So, para mas atos diyang mas ma-absorb and masabtan, aton siyang i-apply sa illustration. So, I am now going to discuss the illustration to apply those dividend rights. So, please take a moment to pause this video and take a screenshot ng aning illustrative problem para makasabay sad mo hinig-solve na to. So, illustration. So, book value per share. The shareholders' equity of Paleleng Company on December 31, 2022 shows the following balances. So, we have the given. First is preference shares na atay 800,000 pesos kay nag-issue ang company og 8,000 shares at 100 pesos nga par value. So, mao ni akong giingon ganina nga 12%, di ba? So, ang preference share is entitled to 12% nga dividends. Next given, we have the subscribed preference share amounting to 200,000. Next is the subscriptions receivable for preference share. We have 50,000. Then we have also the ordinary share where the company issued 41,000 shares at 100 pesos nga par value. So it is equal to 4,100,000 pesos. Then we have the treasury shares or ordinary. We have 150,000. And share premium of 2 million. And last given, we have accumulated profits of 4 million. So in this problem, Paleleng Company only issued dividends up to 2019. So meaning, pag 2020, wa nag-i-issue nga dividends ang company. So in this case or illustration, we will be determining the amount of the book value per share of ordinary share and preference share under each of the following conditions with respect of preference shares. So, mao ni siya ang atong mga considerations in solve nga atong kining illustration problem. So, first, we have the non-cumulative and non-participating. So, we will be solving that one later on. Then, second, the cumulative and non-participating. Third, we have the cumulative but fully participating. Fourth, we have the cumulative but participating up to 18%. And last consideration, we will be solving the cumulative and non-participating, but the preference share has a liquidation value of 110 pesos per share. So, in computing the book value per share, we have two approaches. We can use the procedural approach and the tabular approach. So, sa kaning discussion, we'll be using the tabular approach kay for me, it is very faster and easier nga sabton and mas organized ang process kay naka-reflect na sa table ang mga movements sa mga dividends, movements sa amounts, sa excess in par, and sa preference shares o sa ordinary shares. So, di na tayo maglisod og sabot as we go along with our discussion on this book value per share considering these different dividend rights. Let's first solve the first consideration or required on that illustration problem. So, ingon nga, we will be solving for non-cumulative and non-participating, no? So, sa tabular approach, we only have 3 steps. Ang first step is atong i-compute ang number of shares outstanding and the total par value of outstanding shares for each class of stock. So, we will be determining the number of shares outstanding for the preference share and the ordinary shares. So, start sa preference shares. So, ang company, nag-issue siya og 8,000 shares and subscribe preference shares of 2,000. So, that would be a total of 10,000 shares. So, asa man gikan si 10,000 shares? So, sa 8,000 shares, atong i-add sa 2,000 nga subscribe preference shares. So, it would be 10,000 shares in total. So, with 100 pesos par value, that would give us a total value of 1 million pesos. So, asa man si 1 million pesos? So, kadtong total ganina nga 10,000 shares atong i-multiply sa par value amounting to 100 pesos. So, that would give us an amount of 1 million pesos. So, as to preference shares by treasury shares at par, so ang atong shares outstanding kay 10,000. And still, the total par value is 1 million. For the ordinary shares, the company issued 41 shares. Times nato sa 100 pesos nga par value, it would give us a total of 4,100,000. Then, atong minusan or atong iles sa treasury shares at par nga 1,000 shares. So, the total shares outstanding for ordinary shares kay 40,000. 40,000 and the total par value for outstanding ordinary shares kay 4 million pesos. So, ato siyang gisolve para later on, sayo na lang hinig apply nato sa different considerations kadtong dividend rights nga nida to i-compute. Sa step 2, we will be computing for the total shareholders' equity excluding any subscriptions receivable. So, sa given na atay subscription receivable, but in the computation of the total shareholders' equity, we will not be including that one. So, preference share amounting to 800,000. Then, subscribe preference shares natay 200,000. Then, ordinary share, we have 4,100,000. Then, atong i-deduct ang treasury share nga 150,000. Then, ato na sang i-add ang share premium amounting to 2 million and the accumulated profits of 4 million. It would give us a total of 10,950,000 shareholders' equity. So, we are now bound on the step 3. So, during na nato i-apply or kanang isolve tong mga different required conditions. So, magunad ta sa case 1 wherein we will be computing for the non-cumulative, non-participating. So, non-cumulative meaning, sa to, the preference share is only entitled to the dividends in the current year, and in non-participating, it is only entitled to the fixed rate, to the dividends equal to the fixed rate. So, ang first datong buhaton is maghimo ta og columns as being reflected on the screen. Please take a look na laman para masabtan po ninyo along with our discussion on this. So, atong buhaton first is maghimo ta og column for excess over par, column for preference share, and column for ordinary share. Then, our first item would be the balances. So, atong i-reflect ng mga balances. So, for preference shares, we have 1 million. And for ordinary shares, we have a balance of 4 million. So, this man tagikan sa 5,950,000 nga excess over par. So, tanawa sa screen, naka-reflect na ay nakabutang nga balance amounting to 5,950,000 balance for the excess over par. So, ang kana sidya, that is a total shareholders' equity of 10,950,000 less than the preference shares nga 1 million and minus pod sa ordinary shares amounting to 4 million. Maom natay amount of 5,950,000 nga excess over par. So, the preference dividends, which will be based at 12% nga fixed rate times 1 year, kay non-cumulative man siya. So, we have 1 million times 12% times 1 year. We have a balance for preference dividends of 120,000. Then, ang kanang 120,000 nga preference dividends, that will be declared sa atong excess over par. So ang balance nato sa excess over par kay 5,830,000. Then ang kaning excess nga 5,830,000 will be brought to the ordinary shares na column. So ato na po i-reflect ato no. So ang atong total shareholders equity for preference share kay we have 1,120,000. Then ang total shareholders equity for ordinary shares kay 9,830,000. Then we will be dividing it by the outstanding shares nga 10,000 for preference and then 40,000 for ordinary shares. So sa preference shares, we have 1,120,000 divided by 10,000 nga outstanding share. It will give us a book value per share of 112 pesos for preference and for ordinary shares natay 9,830 atong i-divide sa 40,000. That would give us a book value per share of 245.75 centavos for ordinary shares. So dire nakasolve na tanan natay sa non-cumulative, non-participating atong nasolve ending amounts of 112 pesos for preference shares, and for ordinary shares we have 245 pesos and 75 centavos. So next condition, we will be solving the case number 2 or the cumulative and non-participating dividend right. So since cumulative man siya, it is entitled to the dividend in arrears. And ingon man po dere nga non-participating, still entitled only sa fixed rate amount that is 12%. So same process will be reflecting all the balances than the preference dividends. So if you notice, 2 years na ang nakabutang kay di ba sa problem ingon man nga up to 2019 nga nag-declare og dividends ang company. So pag 2020 o 2021 wala nag-declare og company og dividends. But since kay ang atong condition here is cumulative man, where we will be the preference share is entitled to those undeclared dividends from 2020 o 2021, so meaning entitled siya sa 2 years nga preference dividends. So upon solving, ang kaning 1 million atong i-multiply sa 12% nga fixed rate, and then ato na po sa i-multiply sa 2 years, which is ang preference share is entitled to 240,000 nga preference dividends. And then it will be deducted sa excess over par. So ang balance na atong i-carry over sa ordinary share kay 5,170,000. So that would give us a total shareholders equity for preference share of 1,240,000 and 9,170,000 for ordinary shares. So ato na silang ipang divide with the outstanding shares of 10,000 and preference shares and ordinary shares respectively amounting to 40,000. So it would give us a book value per share of 124 pesos for preference share, and for ordinary shares we have 242 pesos and 75 centavos. So we are now bound to compute the case 3 or the cumulative and fully participating. So cumulative, entitled to all dividend in arrears and fully participating. And it is entitled not only to the fixed rate but also to the pro rata distribution of the net excess over par. So same process, magbutang ta sa mga balances atong i-reflect. Then next kay ang preference dividends nga 240,000. So if nakabantay na pud mo, naa na tay ordinary share dividends kay inasmuch as the shares are fully participating, naa pud tay i-issue nga ordinary shares which ang rate nga atong gamiton is equal to the rate sa preference dividends if way given nga ordinary shares. So atong problem wa may given, so we will be using the 12% fixed rate. So wa man no may given, so ato na tong gamiton. So the 4 million nga total amount of shares outstanding atong i-multiply sa 12% fixed rate, then multiply sa 1 year or 1. So it will give us the amount of 480,000 sa ordinary share dividends. And i-deduct ni nato nga amount ato sa excess over par. So ang atong balance sa excess over par after deducting the dividends kay 5,230,000. Then ang kaning amount will be distributing it to preference shares and ordinary shares pro rata. So ang atong buhaton ingani is mag-ratio ta. So preference shares total og total sa ordinary shares. I-add na nato kung ilang total. It will give us a 5 million base. Then after that, ang atong gamiton nga formula kay 1 million divided by 5 million times 5,230,000 and kanang ato pong isolve ang 4 million ato i-divide sa 5 million ato i-multiply ang ilang answer sa 5,230,000. So it would give us an amount of 1,046,000 for preference shares and 4,184,000 for ordinary shares. So the total shareholders' equity is 2,286,000 for preference shares, and we have also a total for ordinary shares amounting to 8,664,000. Then, i-divide nato sa outstanding shares. So, it would give us the book value per share amounting to 228 pesos and 60 centavos. Sa preference shares pod, naka-contact answer nga 216 pesos and 60 centavos for ordinary shares. So, next case is case 4. So, here, agatong consideration or atong i-solve is ang cumulative and participating up to 18%. Kung moingon ganita participating up to 18%, meaning up to 18% ra ang atong ma-issue nga dividends for the preference shares. So if naa gani tay existing fixed rate, ang excess ra sa existing nga fixed rate up to 18% maurang atong i-distribute sa preference share dividends as balance for participation. So we will be now still same process, matag columns, and then we will be reflecting the balances and the preference dividends for 2 years. Kay cumulative man sa dyan, no? So, nata ay 240,000, and then ordinary share dividends nga for 80,000. So, after deducting the dividends, we have a balance for participation nga 5,230,000. Ang atong additional nga preference dividends nga ni is ang excess sa 12%. So, 18% minus 12%, that would give us a difference of 6%. And ang kaning 6%, ato ning i-multiply sa 1 million, so equal to 60,000 additional preference dividends. So, i-deduct na to sa balance for participation, it would give us a remaining balance to ordinary share of 5,170,000. So, asa to gikan ning si 5,170,000, ato ni siyang gideduct ang atong amount nga 60,000 atong gi minus ngadto ni balance for participation nga 5,230,000. So, 5,230,000 less 60,000 is equals to remaining balance to ordinary share of 5,170,000. So, we would have a total shareholders equity amounting to 1,300,000 for preference shares and 9,650,000 for ordinary share balance. So, naatay book value per share nga 130 pesos sa preference shares, and sa ordinary shares, we have 241 pesos and 25 centavos. So, the next and the last case or condition that we will be solving here is ang cumulative and non-participating, but the preference share has a liquidation value of 110 pesos per share. So, following the same process, so we will be put up the balances at sa column natin himo. So, preference dividends for 2 years and ang liquidation premium. So, preference share is entitled to the 10 pesos excess. So, ang atong buhaton is ang atong 110 pesos minus 100 pesos is equal to 10 pesos nga liquidation premium per share. So, ato ning i-times or i-multiply sa 10,000 nga total shares outstanding for preference shares. So, it would give us a product of 100,000 liquidation premium balance. So, nanatay balance for liquidation premium. So, ang remaining balance nato for ordinary share kay 5,610,000, and it would give us a total shareholders equity of 1,340,000 for preference shares and 9,610,000 for ordinary shares. Then, atong i-divide sa outstanding shares. So, it would give us a book value per share amounting to 134 pesos for preference and 240 pesos and 25 centavos for ordinary shares. So, that's all the conditions that we might encounter in computing for the book value per share. So, we will now discuss the other half of the chapter 34, which is the earnings per share. So, unsa man dining sa earnings per share? So, earnings per share, it is the amount attributable to every share of ordinary share outstanding during the period. Thus, the earning per share information pertains only to ordinary share. Earnings per share is not computed for preference share because there is a fixed rate of return for such share. So not all entities are required 2% earnings per share. Only the public enterprises are required for this 2% earnings per share to achieve comparability in financial reporting. So on the other hand, more public enterprises are only encouraged but not required for this 2% earnings per share. So there are two types of earnings per share. First is the basic earnings, and the second is the diluted earnings per share. So in basic earnings per share, we only consider the actual outstanding ordinary per share, since ordinary share has um, variable return on investment. And for the determination of the basic earnings or loss per share, basic earnings per share is equals to the net income or loss less preference dividends over weighted average ordinary share outstanding.
Good day, everyone. So before I start my report, let me introduce myself. I am Kimberly Cagna-an, BSA 3A. So my topic is about the options and warrants, right issue and written put options. So first, let us discuss first what is options and warrants. Options and warrants are both securities contracts that give investors the right to buy or sell shares of a company at a specified price and time. However, there are some differences between the two. So, who issues the options, typically traded between investors, while the warrants issued directly by the company. Time frame of options may mature in weeks or months, while the warrants have longer time frames than options. Other characteristics. So option is purchased when it is believed the price of a stock will go up or down, while the warrants usually attach to another financial instrument such as bonds and share. So warrants can lead to the dilution of existing equity shares because the company issues new shares when a warrant is exercised. So ang options and warrants not a dilutive effect only when the average market price of the ordinary shares during the period exceeds to the exercise price of the options and warrants. So we have here a sample problem of the basic and diluted earnings per shares with warrants and options. So the problem here is that Okoboco has the following data at the beginning year. So the net income here is 4 million. The outstanding share from January 1 is 100,000. So the employee share options outstanding during the year, we have here the option shares amounting 9,000 and the exercise price of 120 pesos. Fair value of each share option is 10 pesos. And the average market price is 150. And the ending market price at the year end is 200 pesos. So the requirements is first is how much is the basic earning per share of the year. Second, how much is the diluted earnings per share of the year, assuming share options were issued on January 1 and no exercise of options were made during the year. And third requirement is that how much is the diluted earnings per share of the year, assuming share options were issued on April 1 and no exercise of options were made during the year. And the last requirement, how much is the diluted earnings per share of the year, assuming share options were issued in the previous year and were exercised on September 1 when the market price was 180 pesos. So we have here the basic formula. So the basic earnings per share is equals to net income divided by outstanding share. And the diluted earnings per share is equals to net income divided by weighted average ordinary shares outstanding. So here are the necessary solutions sa atong problem. So requirement number 1, let's calculate the basic EPS or earnings per share. So ang net income is 4 million divided by 100,000. So the answer is 40 pesos per share. Sa requirement number 2, let's calculate the diluted EPS is equals to 4 million divided by 101,200. So it is equals to 39.53 per share. So pag-calculate nato sa diluted EPS, o sa weighted average ordinary share is kung ano na to, i-add ang weighted average plus weighted average of actual ordinary share plus weighted average of incremental share from assumed exercise of options. So 100,000 plus 1,200 na incremental share is equals to 101,200. So pag-calculate nato sa incremental share, i-multiply nato ang option share sa total exercise price nga 120. So pagkuha na to sa total exercise price, ato i-add ang 120 plus 10, so 130. So so 9,000 times 130 is equals to 1,170,000. So mao niya ang proceeds from assumed exercise of options. And then i-divide na to sa average market price during the year nga 150. So mao ang answer is 7,800. So and then option share minus 7,800 nga assumed treasury shares is equals to 1,200. So mao nang atong incremental share. So let's proceed sa requirement number 3. So we have to calculate the diluted EPS. So the net income is equals to 4 million divided by the weighted average ordinary shares nga 100,900. So it is equals to 39.64 per share. So pag-calculate nato sa weighted average ordinary share, i-add lang nato ang weighted average of actual ordinary share nga 100,000. And then i-add nato sa weighted average incremental shares from assumed exercise of options nga 1,200 times 9 divided by 12 is equals to 900. Sa pagkuha, asa nato gikan ang 9 months nga pagkuan is gikan na siya sa from date sa issuance hangtod sa reporting date, which is ang date sa issuance is April 1. So kutob sa December tumaong 9 months. And then the total weighted average of ordinary share is equals to 100,900. So mao na tayo diluted EPS nga 39.64 per share. So sa requirement number 4, diluted EPS is equals to 4 million divided by 104,666 is equals to 38.22 per share. So pag-calculate nato sa weighted average ordinary share is i-add na to ang weighted average actual ordinary share nga 103,000 sa weighted average of incremental share from assumed exercise of options nga 1,666. So gi-times lang ni nato ang 250 times 8 divided by 12. So maong naa si Jai total weighted average or ordinary share nga 100,666. And then sa pagkuha dahil nato sa incremental share, gi-calculate na to ang option share nga 9,000 gi-multiplied na to by 130, which is the total price, exercise price nga gi-add na to ang 120 plus 10 is equals to 130. So mao nang atong total exercise price. So 9,000 times 130 is equals to 1,170,000. Then i-divide na to sa market price at the date of conversion is nga 180. So the assumed treasury share is 6,500. And then the option share minus the 6,500 nga assumed treasury shares. So mao nang ato incremental shares nga 2,500. And then the kaning sa 104,666 umanan niya atong gikuha ani nga. So muna na calculation aning weighted average ordinary share. So let's proceed sa right issue. Sa the right issue are of ordinary shares at the time of exercise or conversion of potential ordinary shares does not usually give rise to a bonus element. This is because the potential ordinary shares are usually issued for fair value. resulting in proportionate change in the resources available to the entity. In a right issue, however, the exercise price is often less than the fair value of the share. Therefore, such rights issued includes the bonus element, which will later have an effect sa computation sa earnings per share. So we have here the illustration of right issue. So the adjusted net income of RFB company for years 2020, 2021, and 2022 amounted 1,008,000 pesos, 1,237,500 pesos, and 1,750,000 pesos, respectively. So here are the additional information. The ordinary shares outstanding prior to right issues, we have 20,000 pesos. Right issue during 2020, 5,000. And then the date of exercise of rights, April 1, 2021. Fair value of shares immediately prior to exercise of rights nga 120 pesos, and the exercise or subscription price nga 20 pesos. So ang requirement diri is determine the basic earning per shares for 2020, 2021, and 2022. So we have here the solution. The step 1 is compute the theoretical market value of share X right. So pag-compute nato is fair value per share right on minus theoretical value of one right. So it's equals to theoretical X rights fair value per share. So 120 minus 20 is equals to 100. And the so pagkuha nato sa 20 is value per one right is equals to 120 minus 20 divided by 4 plus 1 is equals to 20. Then the step 2, compute for the adjustment factor. Adjustment factor is 120 divided by 100 is equals to 1.2. And the step 3 is to determine the weighted average outstanding shares and basic earnings per share sa 2020. So the weighted average outstanding share is 20,000 times 1.20 times 12 divided by 12 is equals to 24,000. And the basic earnings per share is 1,800,000 divided by 24,000 is equals to 42 per share. 42 per share. And then sa 2021 is the weighted average outstanding shares is 20,000 times 1.20 times 3 divided by 12 is equals to 6,000. And then 20,000 plus 5,000 times 9 divided by 12 is equals to 18,650. So, itong i-add ang 6,000 plus 8,750 is equals to 24,750. So, the basic EPS, earnings per share, is equals to 1,237,500 divided by 24,750. It is equals to maong natay weighted average per share. So, ang atong basic EPS is equals to 50 per share. And then sa year 2022, weighted average outstanding share nga 20,000 plus 5,000 times 12 divided by 12 is equals to 25,000. The basic EPS pag-calculate is 1,750,000 divided by 25,000. So, natay basic EPS nga 70 pesos per share. And the last is the written put options. So, the written put options are contracts that requires the entity to repurchase its own shares. Such written put options and forward purchase contracts are reflected in the calculation of diluted EPS in the effect if the effect is dilutive. If these contracts are dilutive during the period, the potential dilutive effect on the earnings per share shall be calculated as follows. So, first is it shall be assumed that at the beginning of the period, sufficient ordinary shares will be issued at the average market price during the period to raise proceeds to satisfy the contract. Second is it shall be assumed that the proceeds from the issue are used to satisfy the contract. And lastly is that the incremental ordinary shares shall be included in the calculation of diluted earnings per share. And that's all. Thank you so much for listening.